Welcome back to FT Markets. Are emerging markets in a crisis? We've seen the word used a couple of times recently in the FT yesterday. Dominic Rossi, equities investment manager at Fidelity International, used the crisis word, and last night the Institute of International Finance also said that the sell-off in emerging market assets had reached crisis proportions. Here today to talk about this with me is James Kynge, our emerging markets editor. James, we haven't had an emerging market crisis since the late 90s, nearly 20 years ago. Is it time to use the word again?
The use of the word crisis really is a subjective decision. Obviously, there's no formal definition of what a crisis is, but one thing that is certain is that the distress that we can see in financial markets throughout the emerging market world and also in the real economies is getting stronger and deeper, and really now beginning to inform the decisions of policymakers around the world. Very significant, I think, was the fact that Mario Draghi, the president of the European Central Bank, mentioned yesterday the weakness in emerging markets is one of his chief preoccupations when he comes to decide whether or not to extend the quantitative easing, the loose monetary policy of the European Central Bank. So obviously emerging markets are moving now towards front and center in terms of policymakers' decisions around the world. Okay. If we look at the first chart here, we can see why this is the case. Here we have the export performance in value of emerging market countries. We've split them into manufacturing emerging markets. Those are emerging market countries that primarily export manufacturing products, and commodity emerging markets. Those are ones that primarily export commodities. And as we can see, the level of distress for those emerging markets that export primarily commodities has really fallen off a cliff since the early part of last year. Yeah. So those countries really are feeling a high level of distress.
Yeah, we can see that. I think if we go on to the next chart, we can see that in their currencies as well. That's the depreciation, the red line in commodity exporting currencies from emerging markets, and the blue one in manufacturing. And this has been the lead, hasn't it, in the financial market side of the crisis. Or if it is such a thing, we've also seen that in a big sell-off in EM equities. We haven't yet seen such a big sell-off in EM debt. A lot of people have pointed out that this time is not like the last time we had an emerging market crisis in the 90s, because back then so many governments from EMs were borrowing in foreign currencies. So when their own currencies depreciated, their debt costs soared, and they were sitting ducks for targeting by the hedge funds and others. This time around, they are borrowing in their own currencies, so they're less vulnerable, goes the argument. But a lot of people are now starting to notice that two things have happened. Not only have we had a big build-up in foreign currency debt by emerging market corporate borrowers, which is feeding back as a form of shadow banking even into their domestic economies, but also the sovereign borrowers have built up a huge amount of debt in their own currencies, and just because it's not what was called original sin, borrowing in another currency, it's still problematic, and those levels have really soared. So we're starting to see some stresses there too. If we move on to the next chart, we can see how this is feeding back into those people's real economies. Here we have GDP rates in developed and emerging markets, again split up into manufacturing and commodity exporters. Does this ring another alarm bell for you?
What's significant about this chart, I think, is that we can see that the last time emerging market GDP growth fell below the rate of developed market GDP growth was in the late 90s. That was the Asian crisis time. Now, at the moment, if you split out those commodity exporting emerging markets, you can see that their GDP growth rates have already fallen below the developed market average. This is not the case for the manufacturing EMs, who appear to be doing fairly well at the moment. But if we're talking about whether or not this is a crisis, my personal view would be that there isn't an emerging market crisis until we start seeing negative GDP values pretty much across the board in emerging markets, or at least in a camp of emerging markets such as these commodity exporters. Right. So far, as far as I'm concerned, I would hold off from using the crisis term, But clearly we can see that there is a huge amount of distress in these commodity exporters.
Yeah, and I think as ever, as we've been writing about a lot, the thing is to differentiate between them, and we're seeing different levels of trouble in different markets according to how not only their export profiles, but also their policies and so on. James, thanks very much.
Thank you.